Every great success story attracts both admiration and criticism. Tether, the world's most traded stablecoin, is no exception. Behind its meteoric rise lies one burning question. Is USDT truly backed 1 with the US dollar? Today on DCA Crypto, we explore the critics, the controversies, and the lessons hidden in the firestorm. Tether was designed to be simple, a digital dollar that never fluctuates. Imagine a bridge between the traditional financial world and the fast-paced crypto universe. That's what Tether offered. Traders embraced it for its stability, allowing them to move in and out of volatile assets without cashing out to fiat currency. Exchanges relied on it, making it the primary trading pair for thousands of cryptocurrencies. In a very short time, USDT became the absolute backbone of liquidity in the crypto market. It was the oil that kept the engine running smoothly. But as we all know, with great power comes intense scrutiny. The bigger Tether grew, the louder the questions became. Was this digital giant standing on solid ground? Or was it a house of cards waiting for a gust of wind? The market was about to find out. The core of the controversy has always been about one thing: transparency. Critics argue that for years, Tether operated in a black box, never providing a full, independent audit to prove its reserves. The central question that swirled around every crypto forum and financial news outlet was this: does Tether actually hold enough real US dollars to back every single USDT in circulation? As investigators and regulators started digging, the picture got complicated. Attestations, not full audits, revealed that Tether's reserves weren't just cash sitting in a bank. At various times, they included other assets like commercial paper, secured loans, corporate bonds, and even investments in other digital tokens. This fueled massive skepticism. If the reserves weren't 100% cash, then the promise of 1 USDT equals 1 United States dollar might not always hold true, especially during a market panic. The critics had found their opening, and they weren't going to let it go. Prominent voices in finance and regulation didn't stay silent. Nouriel Roubini, the economist famously known as Dr. Doom for predicting the 2008 financial crisis, repeatedly called Tether a ticking time bomb and a scam. He argued that its opaque reserve system posed a systemic risk to the entire crypto ecosystem. He wasn't alone. U.S. regulators, including the New York Attorney General's office, launched investigations and demanded more clarity, eventually leading to hefty fines and settlements. The most explosive allegation, however, was the one that tied Tether directly to Bitcoin's price. Reports and academic studies suggested that Tether may have printed billions of unbacked USDT to artificially inflate Bitcoin's price during major bull runs. Was it a deliberate manipulation to prop up the market? Or was it simply the market's natural dynamics, with Tether just supplying the liquidity that traders were demanding? The line between the two was blurry, and the debate raged on. The rumors really shook the market, especially during the massive bull runs of 2017 and 2021. Observers noticed a pattern. Huge batches of new USDT would be minted, and shortly after, Bitcoin's price would surge. To critics, this wasn't a coincidence. They claimed that Tether was secretly inflating the market, creating artificial demand and fueling speculative bubbles that could one day burst spectacularly. Imagine building a skyscraper on a foundation you can't inspect. That's how many traders felt. They began to question the very ground they were standing on. Is the value we're seeing real, organic growth, or is it propped up by shifting sand? This fear, uncertainty, and doubt, or FUD as it's known in crypto, became a constant shadow lurking behind every market rally, making traders wonder when, not if, the other shoe would drop. But here's the fascinating part. Despite wave after wave of skepticism, lawsuits, regulatory fines, and countless negative headlines that would have destroyed most companies, Tether has not only survived but thrived. Each controversy, each legal battle, and each critical report paradoxically seemed to make it stronger. The market had multiple chances to abandon USDT, to trigger a bank run and expose it once and for all. But it never happened. Instead, its market capitalization has continued to grow, soaring past $100 billion. This proves a crucial point, at least for now. The market trusts the utility and liquidity of USDT more than it fears the doubts surrounding its reserves. For traders and exchanges, the convenience of a stable, liquid asset on the blockchain has outweighed the perceived risks. Tether has won the market's trust, not through words, but through sheer resilience. The story of Tether teaches us a timeless lesson, not just about crypto, but about innovation itself. Every massive success, every disruptive idea, will inevitably face scrutiny, doubt, and resistance from the old guard. In an industry like crypto, where the very concept of money is being redefined, trust is not just given, it has to be earned, tested, and fought for every single day. The firestorm of controversy surrounding Tether has forced the entire industry to demand better transparency and accountability from all stablecoins. This is DCA Crypto, and we're here to bring you the real stories that matter. Don't forget to subscribe, because the next chapter of crypto history is already being written, and you won't want to miss it. Thanks for watching.